If you've been keeping up with the crypto market lately, it's likely that you've heard the buzz surrounding Bitcoin and crypto ETFs. Blackrock shook the market with a surprise spot Bitcoin ETF application on June 15th and ignited a week-long rally for Bitcoin. In response to this, several other investment firms rushed to file their own applications for a spot Bitcoin ETF within the same month. In today's video, we will explore what crypto ETFs are and what this attention around spot Bitcoin ETFs is all about. First of all, what is an ETF? An ETF is an investment fund designed to track the performance of underlying assets such as stocks, bonds, currencies, futures contracts, and commodities like gold. Similarly, a crypto ETF is basically just an investment fund that tracks the performance of one or more cryptocurrencies and even other crypto-related assets like stock of crypto companies. But for now, we'll focus on the two main types of crypto ETFs, which will be relevant to understand for this video: futures ETFs and spot ETFs. First, let's have a look at spot crypto ETFs. Spot crypto ETFs are backed by physical crypto, meaning that when an investor buys shares of a spot crypto ETF, the issuer of the ETF needs to actually buy and custody the corresponding amount of crypto. Therefore, investors indirectly own the crypto purchased by the investment firm managing the fund. The share price of the ETF reflects the price of the underlying crypto held by the fund. So far, the SEC has yet to approve a spot crypto ETF for the US market, despite multiple filings over X years. However, the world's first spot Bitcoin ETF is the Purpose Bitcoin ETF, launched on the Toronto Stock Exchange in Canada back in 2021. Then we have crypto futures ETFs, which track the price movement of crypto futures by buying crypto futures contracts rather than holding actual crypto. In case you needed a reminder, futures contracts are a type of financial derivative which allow investors to buy or sell the asset at a predetermined price in the future. It's also worth mentioning that prices of futures contracts tend to diverge from its underlying asset, as it is based on market sentiment of the futures market. ProShares Bitcoin Strategy ETF is the first crypto futures ETF to be approved by the SEC in 2021. So what are the benefits of crypto ETFs? Crypto ETFs allow investors to gain crypto exposure without personally holding actual crypto. This removes the barrier of acquiring, storing, and transferring crypto between wallets and exchanges for investors. Besides, traditional and institutional investors will find crypto ETFs to be appealing, as they can be traded in ways similar to a stock. The crypto industry is still young and largely unregulated. With crypto ETFs, investors can gain exposure to crypto assets managed by trusted investment firms like Blackrock, Fidelity, and Van Eck, providing a regulated and convenient way to access the crypto market. Another benefit of crypto ETFs is diversification. An ETF that holds a basket of different crypto provides a one-stop shop for investors looking to create a diversified crypto portfolio. While there are numerous benefits when it comes to investing into crypto ETFs, there are also some disadvantages. ETFs do not track crypto prices perfectly and often lag behind the underlying crypto they are meant to track. Investment firms would also charge crypto ETFs investors an annual management fee, usually about 1% of the investment. This could make crypto ETFs a costly investment over the long term. On the flip side, not directly owning crypto could also be a disadvantage, as crypto ETFs are centralized. This exposes investors to counterparty risk, as the investment firm managing the ETF acts as the custodian of the underlying crypto assets. As the adage goes, not your keys, not your coins. As of now, Bitcoin futures ETFs remain the only form of crypto ETF available in the US market. Despite the increasing demand for a spot Bitcoin ETF, the SEC has been resistant to approving one, having rejected about 30 proposals in the past, supposedly due to concerns over the lack of regulation and potential market manipulation in the underlying Bitcoin market. However, last month, the market stirred as Blackrock, the world's largest largest asset manager with over 9 trillion AUM, applied for a spot Bitcoin ETF. In response, other tradfi titans like Fidelity, Invesco, and Van Eck rushed to submit their own application in hopes for a spot Bitcoin ETF. These initial applications were deemed lacking by the SEC, citing it was insufficiently comprehensive. However, this was followed quickly with the submissions of revised applications, which included a surveillance sharing agreement with Coinbase to monitor and report any illegal activities in the spot Bitcoin market. Recently, it was announced that the SEC has acknowledged Blackrock's revised application for review. Currently, the SEC has accepted several spot Bitcoin ETF applications for review. While approval for any of these applications is not guaranteed, there is speculation that the SEC might finally approve a spot Bitcoin ETF. The reasoning behind this is that it seems unlikely for the world's largest asset manager, BlackRock, to file an application that is likely to be rejected by the SEC. The firm has an impressive ETF approval history with 575 approvals and only 1 rejection.
Rejected.
Time will tell how the situation develops, as the SEC has 45 days from the applications reaching the Federal Register to make a final decision on approval or rejection. That will be soon as August 27th, though it's worth noting that this deadline could be extended up to 240 days. There's no denying that the approval of a spot Bitcoin ETF would significantly add legitimacy to the crypto industry, bridging the gap between the tradfi and crypto space. The influx of institutional investors could lead to increased demand for Bitcoin, potentially driving up its price as a result. While a spot Bitcoin ETF would no doubt mark a major milestone for the crypto space, it does pose some concerns. The recent development regarding the surveillance sharing agreement involving Coinbase raises concerns about privacy. If a spot Bitcoin ETF gets approved, this deal could grant regulators such as the SEC the power to request personal, sensitive information about Coinbase users, including customers' names and addresses. The possibility of tradfi institutions amassing significant amounts of Bitcoin may also leave some worrying about the centralization of wealth or power. However, this is a misconception, as the Bitcoin network, with its proof of work consensus mechanism, does not grant power to large token holders in the same way that proof of stake networks do. Additionally, spot Bitcoin ETF issuers are obligated to buy, hold, and sell Bitcoin according to their investors. As they serve to be the Bitcoin custodians of their clients, they in theory don't necessarily own the underlying assets. Though it still remains that ETFs going mainstream would result in more individuals handing over custody to large institutions, which concerns some that the ethos of Bitcoin would be eroded over time. While concerns aside, a spot Bitcoin ETF would still be beneficial for Bitcoin adoption, as it provides a compliant investment vehicle for pension funds, financial investors, and traditional investors to incorporate Bitcoin into their portfolios. What do you think? Will the SEC finally approve a spot Bitcoin ETF, or will BlackRock take their second ever L for an ETF application? Well, on the topic of Bitcoin, check out this video to learn about BRC20 tokens on Bitcoin.